Oil just crashed 12% in a single trading day, and if you have been watching the markets, you already know that number is not normal. A 12% drop in oil prices in one day is the kind of move that makes experienced investors stop what they are doing and pay attention. It is the kind of number that appears in financial news with words like historic and unprecedented sitting right next to it. And right now across social media and trading platforms and investment forums, the same question is appearing everywhere at the same time. Should you be buying oil stocks right now while prices are at the floor? Or should you be running in the opposite direction as fast as possible? The answer is not as simple as either option suggests, and understanding the full picture before you make any move is the difference between an intelligent decision and an expensive one. To understand what a crash like this actually means, you first need to understand why oil prices move the way they do. Oil is not like most commodities. It sits at the center of the entire global economy in a way that almost nothing else does. Every product that is manufactured, transported, heated, cooled, or delivered anywhere in the world has oil somewhere in its cost structure. When oil prices fall sharply, it is almost always because something significant has happened on either the supply side or the demand side of that equation, and both of those causes carry very different implications for what happens. Next, a supply shock, where oil-producing nations suddenly increase production or a major new source of supply enters the market, tends to produce lower prices for a sustained period. A demand shock, where global economic activity slows down because of recession fears, geopolitical instability, or a sudden reduction in industrial output, is a very different animal and tends to signal deeper problems in the broader economy that extend far beyond the oil market itself. When oil crashes 12% in a single day, the market is almost certainly reacting to news. That news matters enormously to any investment decision you are about to make. Before you put a single rupee into any oil-related stock or fund, you need to know what triggered the move. Was it a decision by major oil-producing nations to flood the market with supply in a pricing war? Was it data showing that global economic growth is slowing faster than expected? Was it a combination of both happening at the same time, which is the most dangerous scenario? Was it something specific to a major oil-consuming region, like a sudden industrial slowdown or a shift toward alternative energy sources moving faster than the market had anticipated? Each of these causes leads to a different set of probable outcomes and a different answer to the question of whether today's crash is a buying opportunity or a warning signal to stay away. The case for buying is built on one observation that has been proven repeatedly across market history. Oil is a cyclical commodity, and cycles eventually turn. Every major oil price crash in modern history has eventually been followed by a recovery. The 2014 to 2016 oil price collapse took the price from over $100 a barrel to below $30. And investors who bought quality oil companies at the bottom of that cycle made extraordinary returns over the following years. The 2020 pandemic crash briefly took oil prices to levels that were genuinely unthinkable. And again, the recovery that followed rewarded patient investors significantly. If you believe the current crash is driven by temporary factors rather than a permanent structural shift in how the world uses energy, then buying quality oil-producing companies at heavily discounted prices while everyone else is panicking is a strategy with a long and successful track record behind it. But the case against buying in a panic deserves equal and serious attention. The energy landscape in 2026 is fundamentally different from any previous oil crash in ways that matter deeply to long-term investors. The transition toward renewable energy is no longer a distant aspiration. It is happening at an accelerating pace across every major economy in the world. Electric vehicles are taking market share from petrol and diesel vehicles faster than almost any forecast predicted 5 years ago. Solar and wind energy costs have fallen to levels that make them genuinely competitive with fossil fuels in many markets. Every barrel of oil that a company plans to extract and sell 20 years from now is sitting in an increasingly uncertain demand environment. This does not mean oil companies are worthless today. It means that the simple assumption that the cycle will turn and prices will fully recover to previous levels deserves more scrutiny now than it did in any previous oil crash. The investors who navigate moments like this successfully are almost never the ones who move fastest. They are the ones who ask the right questions before they move at all. What specifically triggered this crash, and is that cause temporary or structural? Which companies in the oil sector are carrying heavy debt loads that make them vulnerable if prices stay low for longer than expected? Which companies have strong enough balance sheets to survive an extended period of low prices and potentially even acquire weaker competitors at distressed valuations? Is the crash concentrated in a particular type of oil company, or is it hitting the entire sector indiscriminately, which sometimes creates opportunities in companies that have been unfairly dragged down alongside weaker ones. If you are considering any action in response to this crash, the most important thing you can do right now is resist the pressure of urgency. Markets create urgency deliberately. The feeling that you must decide immediately, that the opportunity will be gone tomorrow, that you are watching something happen in real time that you will regret missing, is one of the most expensive emotional experiences in investing. The companies that are attractively priced today because of a 12% oil crash will still be priced attractively in 48 hours after you have had time to read, research, and think clearly. Nobody ever lost money by taking 2 days to make a careful decision. Enormous amounts of money have been lost by acting on the feeling that there is no time to think. Oil stocks may be a genuine opportunity right now. They may also be the beginning of a longer and more painful decline. The honest answer is that nobody knows with certainty which of those is true. What you can control is the quality of the decision you make and the patience with which you wait for clarity before committing your money to either direction.